Adricha. All right. Okay, hey everybody. We are, well, so as you know by now, our course is a project-oriented course, and we're in the last phase of the course, which is where we're focusing on these last two projects. So the very next one that's due is taking your decision tree regression learner, turning it into a classifier, and then using it as part of a trading strategy. The very last project is doing a similar thing, but instead of using decision trees, using Q-learning, with the reward being returns. Anyways, in terms of lectures that we're going to have in the class, I'm going to focus now on some actual strategies that I know about or have been involved in, and some applications of the stuff we've covered so far. As you know, there's no final, so everything I say right now is free, fun discussion. Okay. Now, so I'm going to. That's not to say that the lectures won't help you on your projects. And in fact, at the end of each lecture, I'll be happy to have a sort of question answer. In fact, a technique I've heard folks use is to ask folks to form groups and ask each group come up with a question. And actually, I see like a couple obvious groups here. So let me ask that group. Raise your hand if you think you're in that group. Okay, more people, more people. Okay, yes, you're in that group. Okay. We'll have a break and let you all consider, but I want you to ask me a question at the end of the lecture. Doesn't have to be, it can be about the project, it can be about Forex. Next group, the center glob over here. Raise your hand. Okay, if you're not looking at me, you're in the group. Okay. The blue shirt guy, tap him on the shoulder. You're in that group. Okay. Everybody in that group, you know what, except for the blue shirt guy, you know what your job is? Okay, come up with a question. You guys. That includes like everybody in these 3 rows, behind the gray shirt guy, and back, you're one group. Pat is his own group. And you folks, and including these 2, okay? And Adrija is her own group, okay? All right, so once I finish the lecture part, I'll ask you all to collude and think about a question. Please ask a question that I can answer, so I'm not embarrassed on live TV, but, well, it's not even live. I'll go back and edit it. But anyways, questions about the upcoming projects or about what I lectured on. Okay, so what I'm going to lecture on. I'm going to introduce a topic that used to be part of the class, but it seemed like it was just one too many things to study, so it's not part of the class anymore. However, it's a very useful technique called event studies. So as I talk about it, I want you to consider it and think about how you might use it. In fact, it's a perfect technique to search for strategies like the one you're building for the upcoming project. Then I'm going to talk about a Forex strategy that we built at Lucena that uses event studies as a basis. And Forex is a particular kind of asset. So if you're not familiar with foreign exchange, it's probably, you'll probably find it interesting. Okay, so let me start. I'm going to change this to be screen share. Okay, because of the way things get confused when I'm doing a broadcast and trying to show slides, it works out more conveniently if I show them this way. Okay, let's talk about an event study. What's an event study? Is anybody actually familiar with event studies separate from this class? One person? Okay, cool. Are you a QCF student? Okay, good. It means we're teaching good stuff. All right, here's what an event study is. It was, the idea was pioneered by, I think, a guy named McKinney, but other people have done it too. But it was initially started like sometime in the late 70s or mid 80s. But here, and here was the basis of the original study. To what extent, so the question was, to what extent does positive news affect stocks? And to what extent does negative news affect stocks? So the general idea for it was this. Let's pick some universe of stocks that we're going to study. Let's say S&P 500. Let's pick some time period that we're going to study. Then let's take a corpus of news items. I think they used a Wall Street Journal. And just, I mean, this must have taken an army of grad students. But anyways, they went through their news source and they found, each time they found a positive or negative story for a company, they logged the date and then whether it was a positive or negative story. They went through at least an entire year, maybe even more. In fact, let me see if I have that. Let me see if I have that. Let me find that paper and show it to you, because it's easier to understand if I actually show that to you. McKinley, there we go. Am I going to have to pay for this? Okay. Whew. Okay. All right. 1997. He had been working on this idea before that. Got some math. Don't worry about the math. Here's the important result. Over this time period, every time there was a positive news story for a stock, for a company, they would note the prices of the stock before the event and the prices of the stock after the event, grab that data and put it in a stack. Okay? Then it could be the next story for the same stock later in time. Grab the data before and after, put it in this pile. Do that for every positive news story for every stock, and after a while you have, for instance, maybe hundreds of examples of positive news stories. Do the same thing for the negative news stories, but the procedure is the same. And here's the procedure. Remember now, we've got all these examples of what happened to the stock up to the event and after the event. You normalize their prices by the day of the event. So what I mean by normalize is you take the price of the stock at the day of the event and you divide all other prices before and after by that price. That means at the middle, at the day of the event, they're all 1.0, right? So that if they go up after that, they might go 1.01, 1.02, several percentages. I'm not doing it. Okay. So we've normalized each stock. Now you take the average of all of them. And the result is that you get sort of a mean line of what happens to the price of the stock in the context of a positive event. Now, that is this line with the sort of diamonds. Now note, let's see if I can, let me grab something else here. I'm going to use this as kind of a ruler. You'll see what I mean in a second. Okay, this vertical line is sort of my ruler. 0 is the day of the event. So it's worth noting that prior to the actual news event coming out, the stock price for the positive events had been migrating up slightly, right? Let me put this over on the other side so you can see what happens afterwards. So we have this rather quick move up the day after the event, and then kind of a stabilization in price for positive events. Anyways, this line going through the middle is random days for random stocks just as a control. And so as you can see, on average, things just kind of mosey along horizontally. This is the curve for negative news events. One thing that, so an important thing that's missing from this study that would be really useful, and if you do a similar research yourself, it would be really nice to have error bars above and below indicating what was sort of the variance of these events. So if the variance is really wide, it's less of a useful study. But if it's fairly narrow, it tells you, yeah, most of the stocks stay in this range. But anyways, something I observe for the negative news is stocks respond very aggressively to negative news. Perhaps overreact, and then tend to recover a bit. So sometimes there are trading opportunities after a significantly negative event where the market sort of overreacts, and that's a buying opportunity that you can capture on its return back up. Anyways, that's an event study in the context of news stories. They've actually done this sort of study now on intraday news. Like they'll somebody will be watching MSNBC or whatever the business one is, and be tracking stock prices as the reporter says something, and you can see them move up and down. That's why some hedge funds actually specialize in voice recognition, and they literally watch the news and trade stocks that are being talked about. Okay, any questions on what an event study is? Okay, we got a question in the special section up here. Yeah.
Have you backtested this at Lucena recently, like using an RSS feed? And has it been arbed out?
So the question is, have we tested this at Lucena recently, and if so, has it been arbed out? We have not tested news feeds, although there are there are a lot of vendors that provide news feeds. In fact, there's one by Thomson Reuters that has been optimized for high frequency trading. In fact, they send you it's optimized so that the whole message is in a single TCP/IP packet. Maybe they even use UDP, I don't know. But so the stock symbol is somewhere in that packet, and then there's like a positive or negative bit. And if you're co-located on the New York Stock Exchange, for instance, they've got a co-located machine that'll zip it to you. Anyways, long story short, we don't do high frequency trading at Lucena, so I can't answer intraday stuff. I can say that we have a few data vendors that provide sentiment data. One of them looks at tweets. Actually, we've got two different ones that look at Twitter activity, and a third one that looks at news events. We do in fact see trading opportunities in all three of them. We don't have an active trading strategy with it yet, but it looks like they are useful information. I will say that for all these feeds, all this kind of sentiment feed and news feed, you have to act rapidly. The value of the information expires very quickly.
The last time I tried it, I lost $5,000 in 15 seconds.
Mm. You spent $5,000, and you lost $5,000 in 15 seconds. Okay.
Just a warning.
Okay. Yeah. Well. So. Yeah. I think this would be something you don't go home and do right now. Just alerting you to the idea. Okay. Now I'm going to show you some slides from Lucena. I am not trying to sell you anything. It just so happens I work at Lucena, and fortunately, my interests at Lucena and at Georgia Tech overlap, so I don't have to do everything twice. Anyways, let me thank Lucena for allowing me to show these slides, but they're relevant to this class. Okay, so, and let me thank my co-founder there, Eris Katz, for putting together these slides. Okay. Event study. So I talked about it a little bit. Here's another example of how we do this at Lucena. So again, instead of a event being a news event, there's other kinds of events. It might be a Twitter alert, but it might be an announcement of earnings. It might be a technical event, like the stock spiked 5% this morning. There are lots of different ways to define an event. A way on our platform that you can define an event is you can call up an indicator. We've got like 450 of them. And then you can set an upper and lower threshold on that indicator. And you can say anytime the value of the indicator for this stock is between those two values, that's an event, and record it and act on it. Now, sometimes a single indicator isn't useful enough, so you might have several. You might have 3 indicators, and set thresholds for, if they're all met, that's an event. Just like your homework. Your homework is overlaps very significantly with these event studies. However, and by the way, this is very similar to a stock screen. Like, you can go onto Google and say, show me all the stocks with a PE ratio of this, with a price volume of that, and list whatever indicators you're interested in, and it'll show you today all the stocks that pass that screen. But what it doesn't tell you is, if I had used this screen 5 years ago, checked it every day, and bought stocks that pass that screen, how well would I do? That's what the event study does. It lets you take this screen or list of criteria, go back in time and test it every day for whatever period you want, grab those before and after prices and analyze them. Now we take it a little bit further by looking not just at a single stock, but simultaneously at a universe of stocks, usually S&P 500. So to recap, we have some definition of what an event is, which is the indicators must be between certain values. We have a stock universe. We go back in time, and each day we check which stocks passed the screen today. and we collect their before and after data and build this chart. So here we're sort of showing this funnel sort of represents that check each day, and each stock that passes the test, we grab the before data and the after data. Now, keep in mind that this same event may recur for the same stock at different time periods. And so this is showing, say for Apple, that the event was satisfied on these different days, and we collect that before and after information for each one of those days. We then aggregate it all together, sort of overlay them over each other. We then take the mean, and you can see that before, for this sort of make-believe event, things are sort of horizontal, and then after it goes up in this particular situation. And then we report some statistics on it, like after how many days, what's the average return we see, and what's the standard deviation on that information. So the tighter these upper and lower standard deviations are, essentially the more reliable an event it is that historically at least would have made you money. So that's event studies and how we do them in our platform called Quant Desk. Okay, now that I've covered event studies, I'm going to switch gears now and tell you how we have applied them in creating a Forex strategy, foreign exchange. So I'm shifting gears now. I'm going to talk to you about what is Forex and why, well, how we developed this strategy. All right, so Forex, all it means is foreign exchange. It just means that you buy currencies of other countries. It's extremely liquid. It's going almost 24/7. There's a short break in the market on Sunday sometime. In terms of volume of this market, I believe the number I'm about to say is true, but I would welcome correction. If you look at the volume of stocks traded on the U.S. market every day, it's about $1 trillion of stocks that trade hands every day in the U.S. markets. Forex is about 5 trillion every day. It's humongous. Another reason that means it's more liquid, say, than stocks is because if you think about the stock market, there are on the order of 10,000 different stocks trading every day, and you divide up that 1 trillion across all these 10,000 stocks. Well, maybe really the top 500 are the most important. You can divide 1 trillion by 500. That's about how much is traded in each of these top stocks. So still a lot, but if you think about Forex, there are mainly only 10 currencies. So the whole market is trading 5 times as much as the U.S. stock market, but in about 1/50th of the number of assets. So that means each asset is huge. So why is that important? Well, it's important because it means that unless you've got a $10 trillion hedge fund, are not going to impact the market very much. So you can trade in this very liquid market with a large fund and not worry too much about market impact. If you remember back, we never got too deep into it, but if you were to trade, say, 100,000 shares of Apple over the period of an hour, you would affect the market, and it would the price would go against you because of the market mechanics we talked about. However, if you wanted to trade that same value in Japanese yen, you would barely affect the market at all. Okay, so a little bit more about Forex. The underneath everything, all that happens is that you start with an account in some currency, let's say US dollars for the purpose of this discussion, and then you buy other currencies. So if you were to buy Japanese yen, let's say you were doing this at Interactive Brokers, they would say, okay, he wants to buy Japanese yen. Let me set up a sub account for him. He wants to put $100,000 in Japanese yen. Boom, it gets changed to yen. Let's suppose $100,000 today turns into 1 million yen. Actually, it should be 10 million yen, I guess. Doesn't matter. Let's just say it's 1 million yen, okay? So now I've got an account in my Interactive Brokers account that contains 1 million yen. If I come back and check that in a week, still going to be 1 million yen sitting there. If I check it in a month, there's still going to be 1 million yen sitting there. It's cash. It's sitting in cash in Japanese yen. So you might ask, why are you doing this if you're just going to always have a million yen forever? Well, I'll tell you in just a second. There is one other thing that I left out. Each night, the Forex fairy comes by your Japanese yen and sprinkles a little bit of interest in there, just a tiny bit. But you know those interest rates, for instance, that we're always worrying about, is Janet Yellen going to raise interest rates or whatever? That's the kind of interest you get overnight on your Japanese yen. Whatever the Japanese version of Janet Yellen has decided, we give them a little sliver of interest payment overnight. Similarly, if you had your funds in US dollars in a Forex account, you get a little bit of the Yellen fairy dust each night. Now it's a tiny, tiny amount, but that comes in each evening. So after a month or two, I might have 1,010,000 yen or something, is sort of the rate at which this interest accrues. Now, here's the kind of thing that can happen. Remember when I bought those yen, I had to convert my dollars, my $100,000, into yen. And every day, at every point in the day, there is a conversion rate that says, okay, if I start with $100,000, how many yen do I end up with? And that's called the exchange rate. And those exchange rates can change quite abruptly. So at the end of, say, this money sitting in yen for a month, the exchange rate may have changed substantially, such that when I convert it back to dollars, now instead of 100,000, I've got 110,000. I mean, that would be a huge change for a month, but I'm just illustrating for purposes. So that's the underpinning of how Forex works. Now, in order to sort of streamline thinking about Forex, we usually trade in currency pairs. So the example I just gave about Japanese yen is leveraging US dollar against Japanese yen. We could also, for instance, go Japanese yen versus Swedish crown, or Japanese yen versus euro. The point is that all these trades are considered in currency pairs. So you're concerned about which one moves relative to the other one. So you're always longing one and shorting the other. So for instance, if I were to trade USD JPY, US dollar Japanese yen, I'm going to be long US dollar, short Japanese yen. And so that would be a trade entering that position. We have focused at Lucena on the G10 currencies, which is essentially the the most liquid set of currencies. And accordingly, there are 90 particular pairs that we might consider trading. Okay, let me pause for a second. Any questions? Yes.
So basically, you're making money by the relative change
In the change in exchange rates.
Yeah, it isn't primarily because of the interest rate.
Yeah. So the interest rate. Remember when we were talking about intrinsic value of stocks? The interest rate is a little bit is related to this intrinsic value. So a country that's paying a high interest rate, their currency might be more valuable than other currencies because of that interest rate. So the exchange rate, the underlying argument there is if you, well, a common practice in Forex is to go long a currency where the country has a high interest rate and short countries with low interest rates and expect that the exchange rate will continue to become unbalanced, because the thought is that longer term the high interest rate currency is worth more than the low interest rate. But still, you only get directly compensated for that by these small interest rates paid over time. Yeah.
You also have to take into account inflation of the country, right? Because a country like Argentina has a very high interest rate, like 40% inflation.
Right. So there's some, there's scads of things I'm like just not mentioning. But yes, the inflation rate for the individual country is absolutely important. And in fact, the factors that we use for building these strategies include inflation, interest rates, GDP or change in GDP, things like that would all affect the value of the currency. And as taking a recent example, the British pound relative to the euro and relative to the dollar took an abrupt nosedive when Great Britain voted to exit the EU. And the thinking, the reasoning for that is that's going to impede people in Great Britain from continuing to have extremely profitable companies. They're going to be less likely to be profitable because their avenues of trade are going to be restricted. And so predicting this maybe higher inflation, reduced GDP, and maybe lower interest rates. Okay. Anything online from Piazza? Okay. All right. So that's the foreign exchange market. Here is a chart of several currencies relative to the dollar, and you might ask, well, how is the U.S. dollar plotted? But let me get to that in a second. Anyways, we took the exchange rate for each of these currencies versus the dollar and plotted it over time. And you can think of this as essentially what's the return you get for buying Japanese yen or a Swiss franc or whatever. And as compared to the stock market, which generally shows a upward moving trend, this seems to just be kind of flat and randomly hovering around zero. And that, to some extent, is true because to a greater extent for currencies versus stocks, it's kind of a zero-sum game, or closer to being a zero-sum game with currencies than stocks. So the way you have to make money is to figure out when one currency is on a downward trend and another's on an upward trend, and hop on that. And when that evaporates, hop out and find the next one. As opposed to with stocks, you can buy and hold, and usually you'll see a return no matter what happens. Anyways, to answer the question that nobody asked about shouldn't the US dollar just be flat if this is all registered against the US dollar, what we did is we registered the dollar against each other currency individually and then sort of took the average over time. Now, the strategy that I'm about to show you, we show here in blue, and it's the one that we developed using event studies and some machine learning that I'm going to tell you about. This is a back test, by the way, but we have been trading it live, and its performance is consistent with that back test.
We have a question from Tiago about how the different currencies vary, as in how the exchange rates are affected. Basically, the question is who sets those exchange rates among different currencies. Also, I assume a change in a particular exchange rate must affect all pairs it takes part, but I've seen that that's always not the case.
Question from online. Part one is who sets exchange rates? It's the market, just like stocks. It's whatever people are willing to buy it for, and whatever people are willing to sell it for. Because there is such a huge demand, the spread, the difference between the best bid and ask, is usually very, very, very small. But it's changing slightly throughout the day. The other question was, I think, shouldn't the exchange rate for a particular currency affect the value of other pairs involved in the currency? And at least the question I think is being asked is something like this: if the dollar-Japanese yen exchange rate changes, shouldn't that affect the Japanese yen Swiss franc exchange rate? And the answer is it's a complex network, and it's not always the case that all exchange rates with respect to that currency don't necessarily always change immediately. I hope that answered the question. Okay, here is an overview of the strategy we developed. Each day we select up to 5 currency pairs to trade. We equally weight each pair, and we invest up to 5% of our portfolio value in these 5 pairs. So what that means essentially is up to 1% in a pair and up to 5 pairs every day. We hold that pair for 21 days, and what that means is each day we're adding 5%, and by the end of the 20th day, we're fully invested, and we're selling our first day's investments and buying a new one. So each day we're rotating out the oldest 5% and picking a new 5%. This, by the way, is a convenient approach to stock trading strategies. One thing that's let's compare this idea of investing 5% each day until you're fully invested versus each month choosing the best stocks and putting your whole portfolio in those. Well, let's compare 2 strategies. One way, each month we find what we think are the 20 best stocks. We hold them for a month, and then we reselect what we think are the 20 best stocks. So compare that to each day we find what we think the single best stock is. We put 5% in that, and we repeat that every day, choosing the single best stock and putting 5% in it. At the end of a month, we're fully invested in 20 stocks, and we're selling the oldest, buying a new one. the difference between those two strategies is, at least in my work, I see frequently that the alpha is only at the very extremes. So, like, if you were to use some kind of machine learning based classification or ranking of the S&P 500, there's only value in like the top handful and the bottom handful. It's not very, the prediction value in the middle is not very good. So alpha is at these extremes. What you get by making a decision every day and selecting only the very best is that you're in what the best was that day. So at least for some choice period, you were in the very best, you're in that extreme. So anyways, getting back to Forex, 5% per day in what we think are the 5 best pairs. One thing to mention is you can, let's say on the first day and the second day, the 5 best pairs are the same. Well, that means that now in each of those pairs, you're 2% in each one of them, and you're 10% invested. We do have a cap that says, for any particular pair, we won't be, I don't know what the cap is, to be honest, but something like 10%. So if we're already 10% in a particular pair, we won't go above that. Okay, so our pairs are driven by macroecon factors, like we talked about, inflation, GDP, and so on, but also technical factors like momentum. We very frequently reconsider which factors we should be using, and I think we evaluate that on a weekly basis. And then we figure out what the thresholds should be based on those factors. So we're kind of doing, we're kind of replicating with machine learning the thing you're supposed to be doing for the first or for the second part of the upcoming project. Okay. Oh, we decide monthly what our scans are. So this is stuff you know already, that this problem is a big data problem, and we can apply machine learning to the problem itself. You've done decision trees. In our case, we did something. We used something called the Cadane method that ends up providing a decision tree for you, but it's a much simplified decision tree over what you all created. The reason we chose, so let me tell you what Cadane does. It picks the first factor. Say you've got a list of 10 factors. You have selected them in a certain order. What Cadane does is it takes the first factor and it finds the upper and lower threshold such that it maximizes return. It then fixes it. It says, okay, we're done with that. Goes to the next factor, and everything that passes through the first factor, it then adjusts for the next factor, upper and lower threshold, to find the best return, and so on and so on and so on. At the end, well, so we have some constraints, like we say that each one of these choices must allow at least 50% of the pairs to survive. But you can see you very quickly limit it to a small number of pairs that survive. Anyways, a reason for doing it this way is it's very, very fast. It's much, much faster than building a decision tree. And what it lets us do is explore all possible combinations. We literally test all possible combinations of factors to decide which ones together work best using this Cadane method. But you could just as easily do it with decision trees. Okay, now I tell you about event studies, which you know already. Okay, so that the middle part of that lecture was decision trees, which you all know about already. I'm gonna tell you now how we can sort of manually apply this method that I described to you. And this is using our platform called Quant Desk, and this is the result of an event study. We start by saying, look, we're not selecting any stocks. In fact, we're gonna select, well, in this case, Forex pairs. We're gonna select all of them for every day, and this is what it looks like. Well, of course, a flat line coming into the event, because on average they're going to be going flat. After the event, they diverge varying amounts, but again, on average, the return is flat because we're taking all of them on every single day. And given that the Forex market is more or less flat, this is what we would expect to see. Is everybody following me so far? Maybe not. Okay. Dave, you follow me? Dave's following me. Okay. Can always count on Dave. How about Pat? A little bit? Okay, good.
Somewhat.
Okay. Let me get to the next one, and then if you can be brave and ask the question. Okay. Now, on our, let me turn off the light so you can see better. So it's weird, the switch for lights over screen doesn't exist. Okay. Don't go to sleep now. Okay, we can indicate, hey, I'm interested in this region. In other words, I would like somehow to select the pairs that go up after the event. And then we can ask our system, which factor could discriminate between the assets that go up here and the ones that don't. So we can, with a little slider, we can indicate the region we're interested in, and we can push a button and say, search through all the factors and find the one that gives us the best result up here. And it searches all the 450 factors, uses this Cadane method to find the thresholds that give us, that's most likely selects assets that end up over here. And then it says, okay, I recommend that you add this factor with these thresholds to your study. And then we just click the button and boom, it gets added. We then repeat that analysis, and you can see now, instead of it just being a flat line, we're seeing indeed we get a little bit of positive return here. We can then repeat that and say, okay, now given that we're filtering all of these assets by that one factor, and it gives us some positive return here, let's search across the ones that pass that scan and find ones that are even further up here. And boom, we get one that's even better. So we've just done, we've just selected two factors and optimized for each one. And you can see we get, this is a much more desirable event study than this original one here. Now, Adricha.
After this explanation, my questions have changed a bit.
Okay.
So first of all, could we somehow think of it as finding the correlation between the factors and eventual output? Because we would want highly correlated factors to be included first.
So her question was, could we consider the correlation between factors and return? Could we consider this to be a problem of correlation? Yes, but let me change that a little bit. Maybe not, and here's why. Because what the Cadane algorithm does is it checks each factor, and then it finds the upper and lower threshold for that factor that gives you the best result, which is a little bit different than finding the factor with the best correlation. They're probably similar, but it's a little bit different, mainly because you're not just saying, give me all the assets that are above this value of the factor, give me the ones that are between this and that. So for instance, it may, as an example, if we were talking about stocks, it may be that negative PE ratios are bizarre and kind of nonsensical. So you might not want to select any stock with a negative PE ratio. On the other hand, extremely high PE ratios may be nonsensical. So if you're using PE ratio, you might find something that's has an upper and lower bound as opposed to just a cutoff. But it is a similar kind of analysis. Did you have another one?
Yes.
Okay.
Here we assume that thresholding, say we chose X1 as a factor for the first threshold, that thresholding X1 will not affect the other factors as such. I mean, the factors themselves are independent of each other.
Yeah, each, you can, one way to think about it is as a tree. And at each, we start with the first factor that we consider, and everything that passes goes down to the right. Everything that fails, we just throw out. And then the next level in the tree is the next factor we can consider. And at the end, the only assets we end up considering are the ones in the very rightmost leaf, and all the other ones are discarded. Thanks for letting me pick on you for questions. Any other questions? Pat?
If speed isn't an issue, is Cadane the strongest method for extracting these features?
Let me repeat the question. If speed were not an issue, would I still use Cadane? Is that maybe the question? That's an ongoing question. I can tell you the following. We have, for the same problems, applied Cadane and decision trees. And without as thorough a study as I would like, but anecdotally, Cadane's doing better. One reason I think Cadane is doing better is because it's a degenerate form of a tree that prevents you from overfitting. It's really, really hard to overfit one of these Cadane trees versus a real decision tree. In sample, we can blow away Cadane with decision trees. Out of sample, Cadane typically performs a bit better. Yeah.
Any questions from the other? The first one is, are these two back-tested data? I mean, these two graphs.
These are, by their very nature, in sample. We pick a period of time we want to study, and these are the results of that in sample study. I should repeat the question. Is this back-tested data? It's an event study taking place over a certain period of time. It's not really a back test. It's an event study. Anyways, event studies are by their nature in sample. Once you find the thresholds that tend to give you this nice sort of decision or event analysis, you can then use those thresholds in forward testing. And I'm going to show you some back tests that illustrate that. So once we use, and this is probably answering that question, once we refine our factors during that in-sample period, we can just, we refined it over several months in history. We can just step forward 1 month and see how it works. And this is out of sample, and it's an out of sample event study because we set the thresholds before we got to this time period. And the point here is that, yes, it continued to work out of sample, and to some extent even better than in sample. Now here's overall our process that I was showing you. We conduct an event study without any constraints. We indicate, okay, we want to find those that have positive return. Look for all the indicators that might help us do that, and iterate, and again, iterate in sample until we're happy with what we see, and then test out of sample. And let me show you back tests now. So orange here is the performance of the strategy. Let me see if I can zoom in on this. I was looking to see if I could tell where the in sample was. I believe that in sample, when we trained the system, was in this period here. So the out of sample performance is what you see going forward there. Anyways, the blue line there is a currency. It's basically a Forex strategy that's available as an ETN, which is a lot like an ETF. Anyways, it performs very nicely in back testing, and we've been trading it live for about 6 months and seeing nice returns from it trading live. Now, when people talk about Forex, you got to remember that nice returns means maybe a few percent per year. But it's essentially rock solid, low volatility, 1 or 2% per year. Another advantage, though, of Forex markets is that you can leverage. So it's very inexpensive and easy to leverage up to 50 times. So that means that 1 or 2% can be 25 to 50%. Okay, one other analysis here, just out of interest. We did a little bit of analysis of which currencies do we tend to be long in and which do we tend to be short in, and the result is that, and you can see each of the currencies along the bottom here. So two observations here. One is there aren't any that are really significantly out of balance. Like if we were to see, one that was comprised 90% of the holdings, we should maybe be concerned that we were too concentrated. The other observation is that well, there are some differences here. For instance, we tended to be in Japanese yen a lot with regard to the short side, and Norwegian kroner as well. Our long favorite was Australian dollar. Anyways, that is the discussion of Forex and how we built a machine learning based strategy on it. Let me take some questions on this, but then I want the groups to get together and each group come up with a question, okay? But any Forex questions? Yes.
You mentioned an ETN earlier. What exactly was that?
Echo Tango November. You know what that is, so I don't have to answer? No, okay. I'm glad to answer. Okay, there are ETFs, exchange traded funds, and ETNs, exchange traded notes. What a fund is it allows people to group their money and buy actual stocks. So SPY is probably the best known ETF. Somewhere there is an account holding billions of dollars of S&P 500 stocks. So the company that runs SPY literally owns those shares. An ETN is something, it's created by banks, but instead of actually holding the assets, they promise that they will deliver on that value. And so they construct, how do they make them? It harkens back to the dangerous times of 2007, 2008. They have contracts and default swaps and other ways of actually making it happen without really owning the assets. In fact, I don't know, do you ever get phone calls where people are trying to sell you silver? No? Okay. You must, Pat. Okay, Pat's checking. Okay. Anyways, the argument, so here's the typical conversation. Blah, 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 blah. I want to sell you silver. And I say, well, if silver's so great, why don't I just buy the silver ETF? And he says, oh, you mean just paper, not the physical metal? And I say, yeah, I mean just paper. Anyways, what it boils down to is some of these precious metal assets, they don't, like if you added up the market cap of all the silver ETFs and ETNs, the guy selling the actual metal will tell you that it's more than there is actual silver existing, and therefore someday something bad's going to happen. And I'm not sure whether that bad thing is going to happen or not. But then the rest of the conversation goes like this. Well, what commission do you charge? Well, it boils down to be about 20%. So he'd be glad to sell you silver at face value with a 20% markup. But he'll buy it back from you for only 10% commission. So anyways, that's why I never buy silver with those people. Okay, any other Forex questions? Yeah.
Sir, I wasn't able to understand why this strategy actually worked. What I felt was that that model was overfitting the data very much.
Okay, let's go back. So the question is, why did the strategy actually work? Let me carry you through, well, finishing the sentence. It seemed like it was overfitting very much. Okay, so here's a process we follow. Think of these steps as ruling out strategies that could never work. Okay, and then at the end you've got a strategy that might work. Okay, so first step is pick some in-sample period, use machine learning to find something that works there. That's in-sample, it could be overfitting, fully agree. But you take steps, for instance, in this case using a type of decision tree that is, hopefully prevented from overfitting too much, the Cadane tree. But anyways, you fit as best you can during that in-sample period. Next, you backtest it out of sample. So you don't change any of these parameters, but you backtest it out of sample. If it doesn't work well, throw it away. Now, if you do that enough times, eventually you'll find one that works out of sample. But it still may be subject to a survivor bias in some sense. Like if all you did was generate random strategies over here, eventually one of them is going to work out of sample. Okay, so, but still, there's no way it's going to work if it didn't work in sample and out of sample a little bit, okay? Now you say, okay, let's test it, let's paper trade it. So we're not using actual money, but each morning we're asking what would it do we enter those trades and we watch over time. If it does well there, then we apply money to it. It still may be that you're just lucky, but at least there are some precautions against it. Yes?
You just mentioned that if some strategy doesn't work, you throw it away and get a new strategy. But the way you define the Killian trees model, how do you even get some new model again? I mean, there's no randomization.
How do I keep from coming back to the same solution? We can, one kind of thing we do is to sort of blacklist factors to prevent it from selecting that factor again. So if this factor seemed to be prevalent in strategies that didn't work well out of sample, we'll say, okay, remove that factor and then start the search over and over again. But you're right. We may, from time to time, duplicate that effort, but we're guaranteed to discover the mistake, in the next step when we backtest it out of sample. I don't know if you're I'm not totally happy with our solution either. So anyways, you definitely do want to not come to the same solution over again, just waste resources. Let me, let's take a 2-minute break, and I want each group to come up with a question, okay? So that group over there, this center group, and you two are in that group. Group in the back, group over there, and then if I don't have enough questions, I'll let Pat answer. Okay, online, we're taking a 2-minute break. Oh, and online questions are welcome as well, of course. Who's got accolades? Alex, we're talking about you. One more minute. You ready? Okay. All right, we'll start from the left here.
So how does currency manipulation affect
How does currency manipulation affect Forex strategies? I will say that currency manipulation is probably one of the strongest reasons people don't use Chinese currency as part of Forex strategies. I don't know anybody who does. I mean, maybe, I don't even know if you can do it because, they have an internal currency and an external currency. But anyways, it's just not used in Forex. You'd be crazy because you don't know. So China's trying China says they want their currency to be a reserve currency, and everybody is saying, No way. You kidding me? I mean, because of that, right? I mean, you don't know what's going to happen overnight. So that's the answer. I'm not just harping on China. I mean, any currency that is potentially manipulated. You know, Venezuela is not part of it either, right? Okay, next question. Boop.
So, have you ever tried to implement some sort of currency carry trade using machine learning? Trying to find a way to select a good borrowing and lending currency to make that trade?
So the question is, have we ever used machine learning to find a good carry trade? And I believe the definition of carry trade is that you're essentially you're looking for an arb situation between a high interest yielding currency and a low interest yielding currency, right?
You borrow at a low interest rate environment and then you lend it out in a higher.
Right. Yeah. Another way of putting that is, can I find the pair? Can we use farming information to help us find the pairs that are going to make sense? So in other words, yeah. I wouldn't say that. So because our trades are over such a short period, 21 days, it's not like we're investing long term in any particular currency. I would say that shorter term information tends to move prices a lot more than longer term information. But if you were going to buy and hold certain currencies, the farm information is certainly something to look at. What our system tends to do, so we do have, I forgot what it's called exactly, but we do have some farming data that we consider, and the sort of signal that we trip on is when there's a substantial change in that information, because that's going to correspond to a news article about something changing. Okay, middle group where everybody's looking at their laptops. What's your question?
So, what happened to the Japanese yen exchange rate after the elections?
Okay, the question is, what happened to the Japanese yen exchange rate right after the election and why? So I don't know what happened to it, but if you tell me, I might be able to speculate. Let me see if I can. It probably changed in favor of Japan because people were so uncertain about what Donald Trump was going to do. But that's my guess. So can you tell me what actually happened?
Well, since the exchange rate go up really fast and then go down again, that's why.
So overnight, as the election results were coming out, futures for the U.S. markets, like you couldn't trade on the U.S. market, but you could trade on futures. Anyways, they predicted a drop in the Dow by like 3.5 points. And probably that effect was reflected in exchange rates. But to be honest, I don't know. I think that would correspond to a increase in the value of the yen, although I don't know that for sure. But by the time the market opened, it changed. So what is that?
USD JPY during the election vote tally, and then you're right, JPY goes up consistently after that.
Okay. Yeah. So it's relative to the yen, the dollar fell, but then as the markets recovered over the evening, the dollar relative to the yen rose. And why is uncertainty. And if you notice, the first thing, essentially everything that Donald Trump has said publicly has been calming. It's okay. I will be a good president. You even notice his tone is like soothing, right? So, and I think that the markets are part of that. Okay, you guys.
So we noticed that when you said that every day you take 5 paisa stocks, and you take an equal allocation of all the stocks. Why the 5 stocks every day and why the equal allocation?
Okay, so this will be the last question because we're a little bit over time. The question was, they saw in my overview of the strategy that each day we bought 5 stocks and we equally allocated between the 5. I think the question is why 5? The true answer is we tried 10, we tried 2, and we looked at the performance of the system, and it tended to peak right around 5. So it was a parameter that we explicitly tested. The equal allocations. The reason we selected that was we didn't have a reason or information that would help us determine how the allocations ought to be different. But that would be worthy of a separate study. But anyways, thank you everybody. Thanks online. I'll see you on Piazza. See you all Thursday.